All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Thursday, everybody. Today is July 30th, 2026. Man, what a day we had yesterday. It was really hard to put this show together this morning, guys. I had to cut a lot of stuff that otherwise would have made the cut that we would have talked about in this show in order to just keep this to any reasonable amount of time. But let's start with where we were yesterday. First of all, the bond market punished Kevin Warsh for his inaction yesterday. Federal Reserve left interest rates unchanged. We had talked yesterday morning how there was like a 35% chance they would hike. The market was unsure, 65% chance they did nothing. We speculated that there might be a little bit of a relief rally if Warsh didn't hike, and he didn't. And we did see stocks very briefly go positive after Warsh's inaction. That was after stocks opened sharply lower to begin the day. They did go positive very briefly. And then Kevin Warsh stopped talking. And when Kevin Warsh stopped talking, the bond market freaked out as if to say, well, what the hell, man? That's all you got to say? Hell no, I'm selling. And we saw the 30-year yield drop to some 12 basis points in a span of just a couple of hours. The yield on the 30-year U.S. government bond is now the highest it has been since June of 2007, a 19-year high on the long bond. Oh, by the way, June of 2007, that was a fun month. That was the month the collapse of Bear Stearns started, when at the beginning of that month is when they froze those two hedge funds that would eventually lead to all the losses in subprime mortgage and the collapse of the firm. Yeah, highest interest rates since that. And by the way, the S&P would end up closing down the Dow would end up closing down 1,100 points on the day. 1,100 points. So look, my TLT guys that are out there, all my guys who are always like, Jack, the conventional wisdom is that during a broad market sell-off, people run for the perceived safety of U.S. government bonds. And you know what? Historically, that has been correct. That has been the correlation. Stocks go way down. People run for safety in the bond market. It didn't happen yesterday. Yesterday, they sold everything. Stocks went down and bonds went down and those yields went up. So keep an eye on that one. All you TLT guys are out there. The bond market threw a fit yesterday and they dragged stocks down with it. Now, also interesting, we talked about that 1,100 point decline in the Dow yesterday. Fun fact, the biggest loser in the Dow yesterday was Caterpillar. What? The bulldozer guy? Aha. But remember, guys, Caterpillar is now an AI stock somehow, because Caterpillar sells a lot of big generators. They put these big diesel engines in. And, you know, all these companies that a year ago were like, we all need to eat crickets and throw out our straws because climate. Well, now they're putting big diesel generators on their data centers because they can't hook up to the grid enough. Yeah, Caterpillar sold off. They caught an analyst downgrade in the morning because of a data center moratorium in New York. Now, let me ask you this. If analysts are downgrading Caterpillar because of a data center moratorium, how come nobody's downgraded NVIDIA yet? Oh, that's right. All these analysts are a bunch of lemmings, and everybody's afraid to be the first one to downgrade the media darling. But yeah, Caterpillar catching a downgrade on data center moratoriums. And that was what started that sell-off in the Dow yesterday. Briefly went positive after the no action and then just freaked out when Warsh was done. The market's telling Warsh, yo, you need to move on inflation. That's what it's telling him. And Warsh did not move yesterday, and he got punished for it. Now, the other big news, Microsoft and Meta earnings. Two wildly different reactions to the earnings in those big tech companies. First, let's talk about the good one. Microsoft, big beat, stock higher by 9% ahead of the opening bell this morning. That was somewhat padded by a big markup in Anthropic shares. Also, Microsoft sharpening their pencil, some of the accounting gimmicks that they're using. But they did see revenue rose 18% year over year. And more important, Microsoft reiterated their capex. Yeah, notice I said reiterated. They did not increase it. The market loved it. They reiterated. And also, if you keep in mind what memory, what copper, what power, what all the inputs into data centers are currently doing, the fact that they are reiterating their capex means on a unit basis, they're building less because they're getting more expensive to build. That's an important caveat there. They didn't cut it, but they also didn't raise it. And by the way, the fact that they didn't raise it, Microsoft also made some accounting changes that we got to talk about. They're fudging the numbers a little bit. That's worth mentioning. And also their free cash flow was down 23% year over year. They are still letting money on fire, and there's still less money in the bank at the end of the quarter than there was a year ago. Now, Meta, on the other hand, Meta, big EPS miss, and the stock is getting punished. They're down 9% the last I looked. Meta also posted disappointing guidance, and they narrowed their capex. Notice I didn't say they raised it. Also, they narrowed it. They raised the lower end of their capex window, and they left the upper end the same. Well, the lower end, we knew you weren't going to hit that, again, because of the price of memory and because of all the inputs going up. And so if you didn't raise the upper end, again, on a unit basis, that is a cut in capex. But that didn't stop them from posting a year-over-year 91% decline in free cash flow. Just $784 million. They were like closer to $9 billion a year ago in free cash flow. Now a few hundred million. Burning that money, and they have nothing to show for it with an EPS miss. Meta stock getting clobbered. Also going on this morning, we've got CoreWeave is struggling to borrow $2.6 billion. They're having to jack up the interest rate further into junk bond territory in order to try to borrow this money. CoreWeave has tapped every corner of the junk bond market at a time when interest rates are moving higher. Oh, that's just great for CoreWeave investors. We've also got Adidas posted record stock decline this morning. A big miss on earnings for Adidas after spending a bunch of money on advertising for FIFA. Pentagon has committed $120 billion for Patriot missiles and submarines. Big spending at the Pentagon here for things that go boom. We'll talk about the companies that are benefiting from that. And last but not least, we got to talk about central banks and gold. Right? Central banks are buying gold hand over fist, right? That's been the narrative from all the gold pumpers all year long, right? Wrong. It's not what they're doing. We got to talk about that one. Stick around for the end of the show. My gold bugs, you're going to want to hear that one. But first, we must shrink my big melon of a head, and let's see what's going on in the world of finance. Don't forget that like button and that subscribe button so you can come back tomorrow and have your coffee with us melon heads, because we do this one every day. And right now, the S&P 500 is higher by 56 points, or 0.78%. It is those Microsoft earnings that are responsible for the index being higher this morning. We've got the Dow is higher by 275 points, or 0.53% in the green. That's after falling 1,100 points yesterday. Maybe a dead cat bounce going on here. And the NASDAQ is higher by 513 points, 1.89%. Again, we got a big bump from Microsoft earnings, partially offset by the smaller Meta earnings. So stocks looking all right this morning. Over in Korea, interesting, down 1.23% for the Kospi index. That's after a two-day decline of some 16% that happened yesterday. Look, here's the interesting thing about Korea. And by the way, guys, there are stories about like cameras going up on bridges to try to prevent people from jumping off of them because of the decline that's been happening in the stocks there. So let's talk about what happened in Korea yesterday. Samsung chip profit soars 250-fold during relentless AI build-out. Yeah, that's right. I don't know. What is that even in percent? 25,000% or 2,500% increase? Yeah, Samsung had a really good earnings report, and they closed red on the day. We saw the same thing with SK Hynix the day before. There is no result that is good enough for these companies because of what their stocks have done and because of how over-levered they are. Samsung closed red on the day. And by the way, that move that we just talked about in the Kospi, it was briefly after those Samsung earnings, it was higher by as much as 6%. And then the index ended up closing down 1.23%, almost 7.25% intraday swing. And this is a quiet day for the Kospi index. That was a subtle, quiet day. Now let's talk about some of the things that the Koreans are looking at doing here. South Korean regulators are evaluating the feasibility of banning short selling amid market crash. Oh, are we calling it a market crash finally? That's good. Jing Finance reports that on July 30th, according to Yonhap News, the Korean exchange recently assessed the technical feasibility of temporarily banning short selling and narrowing price fluctuation limits to evaluate emergency measures that could be deployed during sharp market declines. Oh, price controls for stocks. What's the worst thing that could happen? The assessment included whether the system could implement such measures and the time required to complete adjustments. However, insiders emphasized that only technical feasibility had been confirmed, not any intention to actually implement them. The Korean exchange also evaluated further reducing the current 30% daily price fluctuation limit to constrain single stock declines during extreme market conditions. Previously, the Ministry of Economy and Finance held an emergency market conditions review meeting and stated that given Korea's stock market volatility exceeds both international and historic levels, it will maintain the highest level of alertness and activate a joint 24-hour monitoring mechanism across relevant agencies. So if you're one of these South Korean ants who just watched your life savings go up in flames, you'll be relieved to know that they are closely monitoring the situation in South Korea. And again, the time to worry about these things was when the problem was building, when stocks were going up in a straight line is the time to worry about these things, not when they're crashing back down. Meanwhile, the DXY is a little bit weaker this morning, 100.72. That is lower by 10 basis points. It looked like there may have been the possibility of a little bit of a intervention going on in Japan this morning. We haven't had any confirmation of that, but USD JPY did drop rather suddenly around 6 a.m. this morning. That could be responsible for the weakness in the dollar here. And looking over at the bond market, look at the long bonds. Look at how much higher the yields are there. Again, guys, remember, yields going higher is prices going lower. The 30-year yield is up another 7 basis points this morning at 5.213. It reached as high as 5.24. We'll look at that 30-year chart in just a minute. The 10-year yield, 4.677, higher by 5.5 points. The 2-year yield, 4.252, higher by 1 point and change. And the 1 month is actually down by a point and change. But again, all that big move on the long bond, guys, when you see those selling off and those yields rising, that is the market telling Kevin Warsh, you should have rose. You should have risen rates. Bond yields at 19-year high send Warsh credibility warning. So, wow. Warsh credibility. Isn't it amazing how fast they went from Jerome Powell's abject failure, and yet he was the hero who rescued us. And now 2 months in, Kevin Warsh has credibility problems. What a shift in market sentiment, or at least in media sentiment, towards the Federal Reserve. Isn't that interesting? The message from the bond market was clear. For all of Federal Reserve Chairman Kevin Warsh's tough talk about taming inflation, he's not rushing fast enough to deliver. After the Fed kept interest rates unchanged for a 7th consecutive month, investors dumped 30-year Treasury bonds, sending the yield shooting up as much as 14 basis points to nearly 5.23%, a 19-year high. Market measures of inflation expectations rose, the dollar slid, and even stocks tumbled as investors wagered Warsh was only delaying the inevitable rate hike. So let's talk a little bit about that 30-year yield. Here's where we're at right now, 5.211. We are 1 or 2 basis points off the high. These are daily candles. I want to change this one over to weeklies, though, and let's zoom all the way out here to the late 1990s. You'll see this dotted line going across. Right here is the last time that the 30-year yield was this high, and that was June of 2007. Again, that was when Bear Stearns first started to collapse in June of 2007, the opening innings of the great financial crisis. That was the last time the 30-year yield was this high. And again, guys, when bad things happen, when stocks sell off, historically, you get a big sell-off in stocks, you see yields start to move lower, right? A few months later, when the problems at Bear got even worse, we saw the 10-year yield decline sharply. In 2008, we saw the 10-year yield, the 30-year yield decline sharply. The GFC all the way through 2009, right? The yield dove, it cut. Same thing in 2020 during COVID. We saw yields go down to almost nothing. But now when we have mayhem, we're seeing yields rise. That's interesting. A lot of these historical correlations no longer holding. And everybody alive today, nobody is alive today that ever lived through a period of sustained higher interest rates. The entire financial industry is built on the assumption that rates go down when stocks suffer during market crashes or recessions. That may not be a safe assumption anymore. That doesn't mean they'll definitely go up, but we at least have to question those assumptions now, given what happened yesterday. Also, speaking of inflation, we got PCE came out this morning. The annual move, let's do the regular PCE first. The annual move in PCE was 3.7% year over year. That is down sharply from 4.1 in May. Again, this is the June PCE number. We also saw June CPI came in a lot lower. This was the price of oil. We had the memorandum of understanding. We had a lull in the hostilities in Iran. That's why inflation dipped. It's going to come right back. Core inflation dropped from 3.4 down to 3.3. Core inflation strips out food and energy, so it's less vulnerable to what happened in Iran. Also, memory prices are going to start driving this thing sharply higher as well. And we also got our initial advanced estimate for second quarter GDP. The U.S. GDP rose by 1.5%. That is less than the market was expecting and down from Q1's 2.1%. This is just the advanced estimate. This is going to change several times, but it does look like GDP growth is slowing. And remember, guys, all of that growth, all of it is data centers. And, well, data centers ain't going to be here much longer, at least not the building of them. Looking over at the commodities board, we have got gold higher by $4 this morning, $4,070. Gold held up pretty well yesterday. That's interesting. I thought we would see gold selling off a little bit with the big rise in bonds that we saw, but we didn't see that. The big rise in bond yields that we saw. Typically, yields going higher is bad for gold. So people were looking past the yields. People were looking at inflation. Gold didn't necessarily rally tremendously yesterday, but at the very least, it held on. It gained a couple of bucks. Again, the behavior of market and where money went for safety yesterday was pretty interesting to observe. Gold up about 0.15% this morning. Spot silver higher by 37 cents after having a good day yesterday. Silver was one of the beneficiaries, $58 for spot silver, higher by about 0.2%. I like the shiny. We've got copper higher by 2.1%, platinum higher by 1.5%, palladium higher by 2.6%, and oil is actually lower somehow, $1.13 lower or 1.33% at 83.35 a barrel for WTI crude. Let's take a look at the WTI chart. You can see here big gains earlier this week for oil, but today, or actually big gains yesterday for oil. Today it is lower. Somehow. Let's talk about some oil headlines, shall we? First, Egypt suffers first drone attack, widening the Iran war. What's not being said about this is this drone attack. We have since learned it was the Iranians. Surprise. The Iranians blew up a floating LNG storage facility in Egypt, but it was on this port that is on the Mediterranean Sea, not the Red Sea. All right. So what the Iranians are telling us is don't think you're going to take that Saudi oil and just reroute it north through the Suez Canal and out the Med around Africa and then to Asia. We're going to blow that shit up too. That's what the Iranians told us. And the Ukrainians are saying, hold my beer. Kazakh oil exports halted again after more Black Sea tanker strikes. Yesterday, the Ukrainians hit 2 tankers in the Black Sea that were loading at that Russian port of Novorossiysk, which is at the end of the Caspian Sea pipeline or the Caspian Pipeline Consortium that runs it. They had shut that down last week, and then they brought the production back, well, for a couple of days until the Ukrainians hit it again, and now it's back offline. So somehow oil is down today. I don't know how, but oil is lower. All right, but let's talk about Microsoft earnings here. Microsoft stock rises 9% on strong Azure revenue growth and steady capex spending. Notice steady, not increased. All right, this is the first time in a long while they have not increased their capex. Microsoft stock was trading 9% higher in the after-hours session today after reporting fourth quarter earnings and revenue that surpassed Wall Street expectations while reiterating its capital expenditures forecast for the rest of the year. The company reported earnings before certain costs, such as stock compensation of $4.74 per share, beating street projections of $4.24 a share. But there was a caveat to those results. The figure included 27 cents of unusual accounting benefits, mostly derived from a $3.2 billion unrealized gain on Microsoft's investment in Anthropic. We've seen this over and over again. These guys are creating earnings out of thin air by marking up their valuations of OpenAI and Anthropic, 2 companies that lose money hand over fist. During the quarter, Anthropic's valuation jumped from $350 billion to $900 billion. The company also reported revenue of $90.01 billion, up 18% year over year, and above the street's estimate of $87.62. So that cloud revenue is still growing strong, still driving those top-line results. All told, it delivered net income of $35.77 billion in the quarter, up from $27.23 billion in the year-ago period. And again, a lot of that earnings was just marking up Anthropic and also marking up OpenAI. Now, there's some interesting things here. Their CFO, Amy Hood, she reiterated the company's capex spending plans over the rest of the calendar year, and it's likely that investors were relieved to see no increase, unlike some of its cloud rivals like Google. She said the company also plans to lengthen the useful life of its new offices and data center buildings to 25 years instead of 15 years as before. All right, that's a little bit of an accounting maneuver, extending the useful life of equipment. It reduces your depreciation expense, and it makes your operating income look bigger than it otherwise would be. So Microsoft is doing some accounting maneuvering here in order to inflate those earnings numbers. That's worth pointing out. Moreover, the company plans to switch more of its leases from finance leases to operating leases in the future, with the adjustments expected to lead to roughly $175 billion in capex. So that is an important accounting maneuver also. By switching from finance leases to operating leases, they're moving some of those expenses from capex to operating expenses. So that is a way to artificially lower your capex. So remember, Microsoft said we're not raising our capex, we're reiterating it, but at the same time, they could be hiding the fact that they're actually increasing it using this little accounting maneuver to lower their capex that would shift some of that expenses onto operating costs. So, look, maybe some of you accounting guys out there with a much sharper pencil can go and look at this and scrub those earnings and come up with a hard figure on what the actual impact on capex versus operating expenses is going to be here. But when I see accounting maneuvers like this is a red flag for me. But other than that, great quarter for Microsoft. Microsoft stock is up 9.6%. Big gain for Microsoft here, $428.26, up by 37.5 bucks this morning. So that is driving the indexes higher. Now let's talk about what's driving the indexes lower. Meta stock drops on disappointing guidance and dwindling free cash flow. Meta shares slid in extended trading Wednesday after the company issued weaker than expected revenue forecasts and took a big hit to its cash pile. Earnings per share, $6.18 versus $7.22 expected. Big miss from Meta on earnings per share. Remember, the whole point of this capex is that someday we're going to earn a lot of money from it. Well, it wasn't this quarter. Revenue of $60.8 billion versus $60.17 expected, so a little bit of a beat on revenue. Meta said it expects revenue this quarter of between $61 and $64 billion, or $62.5 billion in the middle of the range. Analysts were expecting $63.15 billion, according to LSEG. So a little bit of disappointment in the guidance there. The company said that the guidance assumes foreign currency is an approximately 1% headwind year over year. Let's see, daily active people came in at 3.6 billion, trailing Wall Street estimates of 3.61 billion. That's kind of important for Meta because Meta doesn't make any money off of AI. They still make their money off of social media, and the number of active users is down. Maybe you should stop tormenting little girls, just throwing that out there. Daily active people measures the number of users on Meta's family of apps. For capital expenditures, Meta narrowed its guidance for the year to between $130 and $145 billion from a prior range of $125 to $145 billion. All right, so they narrowed the range. They raised the bottom end, left the top end alone. Remember, everything they're building is getting more expensive, so it's technically not a cut. But if you look at the quantity of stuff they're building, it's a cut because it's more expensive now. With Meta pouring money into AI infrastructure, Meta's free cash flow dwindled to $784 million. That's down from $8.55 billion a year ago. Guys, 91% decline in free cash flow for Meta. These guys are just destroying money. History will mock us for wasting so much money on such a pointless endeavor. Meta stock getting punished for this one, down 9.07%, $532.92 for Meta stock. It's off by more than 52 bucks. Year to date, down more than 11% now. This one is a dog. But still, guys, the big capex cut, it hasn't happened yet. But this was the big one yesterday, went under the radar. Caterpillar stock downgraded as AI-driven rally faces a big threat. And again, let's just go past everything here. The ground is shifting in many ways. The recent New York State moratorium on data center construction is the highest profile example of a bigger and growing trend towards regulatory action at the state and local level targeting data centers, wrote this analyst named Dobry. This raises costs, adds new development approval hurdles, limits site availability, and likely slows future investment. So that's why he downgraded Caterpillar, and that's why Caterpillar was the biggest loser in the Dow yesterday, because of data center moratoriums. How do you downgrade Cat? and not NVIDIA? How do you do that? How do you have this data center moratorium affecting Caterpillar but not NVIDIA? Oh, maybe it's because people are just buying NVIDIA GPUs and putting them in warehouses and not actually installing them to begin with. Maybe that's why. And NVIDIA is just going to go ahead and keep booking revenue for stuff that nobody's using. I'll just throw it out there. You guys do what you want with it. Caterpillar stock lost 6.9% yesterday, down $58, although it's getting half of that back ahead of the opening bell here this morning, higher by 3.5%. And CoreWeave, surprise, surprise, they need more money. CoreWeave boosts yield on $2.6 billion loan tied to Anthropic. Oh, I just love talking about this company. CoreWeave has sweetened terms on a $2.6 billion loan to fund additional computing capacity for firms including Anthropic in an effort to win over investors growing weary of AI-related debt and bubble concerns mount. Pricing discussions have widened by as much as 1.25 percentage points to as high as 5.5% over the benchmark, according to people familiar with the matter. The loan is also being offered at a wider discount at 97 cents on the dollar versus 99 cents earlier, the people said, asking not to be identified because discussions are private. That further boosts the yield. So they're lowering the price and they're increasing the yield. CoreWeave has also tweaked the loan documents to strengthen creditor protections. I wonder if they're getting a cosign from NVIDIA again. The people added. Investors have until Thursday to place orders. And then I just love this sentence. CoreWeave has been tapping every corner of the junk debt market as it is expected to spend more than $34 billion this year alone in AI infrastructure. And if only there were horror stories that begin with company X has been tapping every corner of the junk bond market, right? We never have stories about people losing a whole bunch of money that begin that way, right? This always ends really well for the investors. CoreWeave stock is recovering all it lost yesterday. It's higher by 10.25% this morning after losing 9.6% yesterday. So basically sideways over the last 2 days, $67.09. I can tell you guys, if interest rates are really going sharply higher for the foreseeable future, this company is toast. If interest rates are not going sharply higher for the foreseeable future, this company is still toast because they lose money on everything they do. Literally everything. This company has never made a penny. Meanwhile, interesting one in the apparel sector. Adidas shares on course for record drop as World Cup spends eats into earnings. Now, this one's kind of interesting. I don't want to spend too much time on this one. They spent a ton of money advertising for the World Cup. And they did increase their operating income. It was up by 5%. So they did get a little bit of a return on that investment. But the stock had rallied like crazy going into the World Cup. And it looks like investors just got a little bit ahead of their skis because they did make money on that big investment. But it wasn't really it wasn't a lot of money. They made a little bit of a 5% increase in earnings when you spent hundreds of millions of dollars on advertising. Was it worth it? You tell me. Stock right now down, look at this, down 17.3%. This thing got absolutely clobbered. But if you notice, the stock, look, it had rallied all through May, June, July. I mean, this stock was ripping. It went from about $140 a share and then up to as high as $188 a share during the World Cup. Now it's back to $150. So just kind of made one big circle here. But this would be the worst day on record for Adidas stock. Meanwhile, things that go boom are, well, booming. Pentagon commits over $120 billion for Patriot missiles and submarines. The U.S. military's mega deals with Lockheed Martin and shipbuilders aim to guarantee availability of equipment over time and stabilize suppliers. The Pentagon on Wednesday earmarked more than $120 billion for contractors to step up production of Patriot missiles and long-delayed submarines to support future combat operations. The Patriot contract with missile maker Lockheed Martin is now valued at nearly $59 billion, a significant expansion of an order announced in April. You may recall there's been a lot of talk about the dwindling stockpile of interceptors because of the war in Iran, so they are spending tens of billions to replenish those and increase production of them. At the same time, the Europeans are starting to license production of Patriots over there. The world is gearing up for World War III, which is unfortunately well underway, folks. General Dynamic Electric Boat and Huntington Ingalls Newport News Shipbuilding received $76.6 billion in this deal for 9 Virginia-class and 5 Columbia-class nuclear submarines that will be delivered by 2038. The Virginia class is the hunter-killer submarine that targets ships and other subs, and the Columbia class, that is the boomer or the ballistic missile submarine that can be used for attacking other ships or land targets. Replenishing munitions stockpiles and increasing shipbuilding capacity are top Trump administration priorities and have been pain points for the U.S. military. Congress must still provide annual funding for the deals. The modified Army contract for more Patriot missiles also comes as demand surges for the defensive weapon used heavily during the Iran war and in Ukraine. And Huntington Ingalls stock is ripping this morning higher by 10.85%. Full disclosure, I own this one, trading at $311.21, up by $30 a share. I also own General Dynamics, which was also mentioned in this article. Let's just bring that ticker up while we're at it. General Dynamics, again, I own this one, not really moving. That's actually down a fraction of a percent on this announcement. And the third one that was mentioned was Lockheed Martin, which I do not own Lockheed Martin either. That one is also down a fraction of a percent here. So really only Huntington Ingalls is moving on this announcement by 10%. I'm not really sure why Huntington is doing so much better, whereas General Dynamics and Lockheed are lagging a little bit here. But stuff that goes boom, doing pretty well this morning. All right. And we got to do this one for my gold bugs, right? Because everybody knows that central banks in particular, are buying gold hand over fist, right? All these gold dealers are doing interviews, some paid, some not paid. And they're talking about how the central banks, in particular in China, they're buying all the gold in the world. And therefore you should buy all the gold in the world from me, right? That's how these interviews go. Well, it turns out that was largely bullshit. And I don't think we're going to hear about this on the pumper channels, but it's important. Now, look, guys, I love gold. I own gold. I love silver. I own silver. I'm big on protecting yourself from the eroding effects of inflation by owning precious metals, but I am not a cheerleader. I don't own pom-poms. I call it like I see it. And there are people out there who push this too far, and they have questionable interests. And it's important to remember that people in the gold industry are not necessarily your friend. They're human beings, just like anybody else. They are prone to the same vices, virtues, and everything that comes along with being a human being. They're flawed individuals. Some are good, some not so good. And this story kind of pisses me off. Central banks bought far less gold than thought at the start of the year. How much less? A lot less. Central banks bought far less gold at the start of the year than previously thought. And while demand has since rebounded, their purchases are expected to decline this year, according to the World Gold Council. Central banks only bought 57 tons of gold in the first quarter. That is 187 tons less than previously thought, the industry group said in a report on Thursday. All right, so let's just do a little bit of quick math. 187 tons plus 57 tons. So the World Gold Council told us that central banks bought 244 tons of gold in the first quarter when they actually only bought 57. So sorry, guys. We were only off by a factor of 4. The number was actually 23% of what we told you it was. Oops, our bad. Oh, did you go out and YOLO into gold at an all-time high because some guy said something about a central bank buying gold? Oh, we're sorry. We're real sorry. There's a camera on a bridge in South Korea somewhere if you're worried about that. Yeah, they just, I don't know how you could be so wrong about this, but they were. That's the weakest start to the year in well over a decade, according to WGC data. And the revision means the overall pace of purchasing this year is likely to fall below 2025. When's the last time you saw one of these gold CEO interviews where they told you about central banks buying less gold than they were a year ago? Or do you think these guys are going to pay a YouTuber to bring them on the air to talk about how sorry that number I gave you back in January was actually off by a factor of 5x? No, they're not going to do that. But they were colossally wrong about how much gold central banks were buying. The original estimate had reassured bulls that the institutions, a key driver of bullion's multi-year rally, were returning to the market in force to buy after prices dropped from an all-time high. The metal's lost about a quarter of its value since the Iran war began in late February, as higher energy costs stoked inflation concerns and pushed back expectations for interest rate cuts. A large share of the central bank's buying captured in the WGC's estimates isn't disclosed by monetary authorities themselves. Consultancy Metals Focus Ltd calculates the estimated purchases on behalf of the council using a combination of public data, trade statistics, and field research. All right, so it was this consulting firm, Metals Focus Ltd., that gives the numbers to the World Gold Council, and then they advertise them, and then everybody pays to go on YouTube and to talk about them. And it turns out they were way off. If they're really using estimates and field research and public data, how could they be off by such a huge margin? Or maybe they were just making it up in order to sell more gold. Again, guys, I'm bullish gold. I'm bullish silver in the long term. I am heavily allocated to both metals. I believe both metals are good investments. But I don't believe in blowing smoke up people's asses with phony talking points in order to inflate your own sales if you're a gold dealer. And I see a lot of gold dealers who do that. So just keep that in mind, guys. Question what you hear on YouTube. That includes for me. Oh, Jack said a thing. I'm going to go out and buy or sell this. No, go listen to the people who say the opposite of what I say. There's plenty of them on CNBC, and make up your own mind about who's telling you the truth. I get them wrong plenty of the times. But I can tell you, I turn down the money from a-holes like this. I don't take their money. They offer it every day, and I don't take it because they have a conflict of interest. And unfortunately, in the finance space, it's really hard to avoid conflict of interest. And so it's better to just not take money from any of them, which kind of sucks for your bottom line if this is what you chose to do with your life. But hey, that's just me. What can I say? Hey, guys, I just want to say thank you for having your coffee with the Melon Heads this morning. Appreciate all your time. Don't forget that like button and that subscribe button for the YouTube algorithm. Thank you also to my magnanimous Melon Head supporters on Patreon, YouTube members, and Buy Me a Coffee for supporting the channel. You guys are awesome. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.